You know, when you think about it, the best writing is almost always the simplest. Just think of that classic little book, The Elements of Style. It just boils down the whole art of writing into a few basic rules. So, what if we could do that for something as complicated as investing? Well, it turns out two of the greatest minds in finance, Burton Malkiel and Charles Ellis, did exactly that. In their masterpiece, The Elements of Investing, they give us the simple, really powerful blueprint for financial success. So let's break it down. And hey, don't just take my word for it. The guy who literally won a Nobel Prize for his work in economics, Harry Markowitz, calls this a lifelong manual for financial success. I mean, when a Nobel laureate gives that kind of endorsement, you just know the advice is solid gold. All right, so here's our game plan. We're going to start with the absolute foundation, saving. From there, we'll get into the right strategy, how to manage risk, and maybe most importantly, how to avoid becoming your own worst enemy. And then at the end, we'll wrap it all up into one super simple plan. First up, the most important piece of the puzzle. Seriously, before we can even talk about stocks or bonds or any kind of fancy strategy, we have to talk about the bedrock of building wealth, saving. Because let's be real, a 10% return on $0 invested is still zero. It all has to start right here. Now, the reason saving is so powerful, it all comes down to one single concept: compound interest. It's so incredible that Albert Einstein supposedly called it the eighth wonder of the world. It's basically the magic of your money making more money, and then that money turning around and making even more money. It's like a snowball rolling downhill, just getting bigger and bigger for your wealth. And here's a way to make this idea super simple. The rule of 72 is your new best friend for getting a feel for compounding. You want to know how long it takes to double your money at, say, an 8% return? Just divide 72 by 8. Boom, 9 years. It's this awesome little mental shortcut to really feel the power of what we're talking about. And this slide right here, this just shows you why starting early is, well, it's everything. So meet William and James. William invests for 20 years, from age 20 to 40, and then he just stops. He doesn't add another penny. His twin, James, starts later at 40 and invests for 25 years, actually putting in more of his own money. But just look at the final numbers at age 65. William's nest egg is over 6 times larger. How? It's just those 20 extra years of compounding. It proves that time in the market is so much more important than timing the market. Okay, so this leads us to a rule that you absolutely cannot break. Before you can even start saving, you have to stop what the authors call dis-saving. And enemy number one is high-interest credit card debt. That's the rule of 72 working in reverse, doubling what you owe every few years. It's a financial hole that makes it practically impossible to build any kind of real wealth. So, you've built a solid foundation. You're saving. Now, the next logical step is to put that money to work. The book argues that when you step into the market, you can play one of two games. And you know what? Only one of them is really designed for you to win. So on one side, you've got the loser's game. This is the world you see in movies, trying to be the next superstar stock picker, trying to time the market perfectly. It's all about high fees, high stress, and high anxiety. But on the other side, there's the winner's game. And this is just simple. You own the whole market through a low-cost index fund. You're not trying to beat the market, you're just trying to be the market. So if it's that simple, why is everyone always talking about the loser's game? Well, this quote from Upton Sinclair just hits the nail on the head. The financial industry makes its money from fees, from trading, from active management. Their salary literally depends on you not understanding this, on convincing you to play a game that's incredibly difficult to win. And the data is just overwhelming. Look at this. Over any real length of time, the vast majority of professional, highly paid fund managers fail to beat a simple, boring S&P 500 index fund. That's just a fund that holds the 500 biggest U.S. companies. After you factor in their higher fees and all their trading costs, they just can't keep up. Playing the winner's game is statistically the smartest bet. Okay, so you're saving. You're playing the winner's game by owning the market. Awesome. But how do you protect yourself from the downturns that you know are going to happen? Well, this next principle is what experts call the only free lunch in investing. It's the key to managing your risk without hurting your returns. Diversification. I'm sure we've all heard the phrase, don't put all your eggs in one basket. Well, this story makes that advice feel painfully real. There was an employee at Enron who had her entire retirement savings, nearly $3 million, invested in her company's stock. And when Enron collapsed, her entire life savings just vanished. It's a tragic but incredibly powerful lesson on the dangers of not being diversified. And diversification isn't just about owning a bunch of different stocks. It really has three parts. First, you've got to spread your money across different types of assets, like stocks and bonds. Second, you have to diversify across different markets, so some in the US, some international. And third, and this is crucial, you should diversify over time by investing regularly. This is called dollar cost averaging, and it just means you automatically buy more shares when prices are low and fewer when they're high. It smooths out your returns and keeps you from making that classic mistake of dumping all your money in right at market peak. All right, on to our final core principle. You can have the perfect plan. You're saving, you're indexing, you're diversifying, but there is one thing that can still wreck it all. And that one thing is you. This last section is all about mastering the psychology of investing. So let me ask you, who is the single biggest threat to your long-term financial success? Is it a stock market crash? A bad economy? Some slick financial advisor? Well, according to decades of research, the answer is the person looking back at you in the mirror. The legendary investor Benjamin Graham gave us this incredible metaphor. He said to think of the stock market as your business partner, Mr. Market. And this guy is wildly emotional. Some days he's euphoric, he's on top of the world, offering you insane prices for your shares. Other days he's terrified and wants to sell you everything he owns at a massive discount. The secret to success? It's to ignore his moods, not to trade with him based on how he's feeling that day. And this isn't just a clever story. The data proves it's true. Study after study on where investors' money goes reveals this totally predictable and totally destructive pattern. People get greedy when prices are high and they pour money in. Then they get scared when prices are low and they sell everything. They consistently buy high and sell low, turning what should be a winning game into a losing one. So we've covered a lot of ground. Let's bring it all together with a super simple summary. This is what the authors call the KISS approach to investing. Keep it simple, stupid. It really just boils down to this 6-step path. Number 1, save early and often to harness the power of compounding. 2, get rid of compounding's evil twin, that high-interest debt. 3, play the winner's game with simple, low-cost index funds. 4, protect yourself by diversifying, well, everywhere. 5, tune out the emotional noise from Mr. Market. And number 6, and this is the hardest part, stay the course. Through all the ups and downs, just stay the course. And we'll end with the author's own promise. It's not about finding some secret formula or a get-rich-quick shortcut. It's about understanding that the most effective path to financial security isn't complicated or exciting. It's simple, it's disciplined, and it's incredibly powerful. So I guess the real question is, in a world that's always trying to sell you complexity, do you have the discipline to stay simple?